When it comes to AI stocks, we all wish we would have seen the trend coming before. And yes, I'm looking at you, Nvidia, and Palantir. And recently, there's been a lot of buzz about Nebius becoming the next AI giant. In this video, I'm gonna share with you whether or not this is likely to happen, and I'm also gonna share with you my price prediction for the stock. The story of Nebius and how it became a public company, it's actually really interesting, and this is because back in the day, they were part of Yandex, and Yandex, for those of you who don't know, is known as like the Google of Russia. So they develop, of course, a search engine that works really well in Russia apparently, and then they developed a whole bunch of products that were very similar to what Google was doing. They even developed some cutting edge self-driving technology, so that was really interesting. However, because of the events of the Ukraine-Russian war, the company was actually originally listed in the Nasdaq, but because of these events, the company was hit with sanctions, and the company's CEO and founder, who's now the CEO of Nebius, was like, you know what, we're not going to allow this. So what we're going to do is we're going to restructure the company, get rid of all the Russian assets that are causing a problem for the company, and then we're going to restructure the company into a very powerful, innovative AI company. So even though this was very difficult, they were able to accomplish this, and then Nebius AI was born, which is the stock that I'm talking to you about. And what they do is actually really interesting. So if you look on their site, you'll see that what they do is they have a whole bunch of essentially data centers or compute centers where you can leverage all of the different technology that companies like Nvidia have built to get all these different GPUs. They have access to a whole bunch of those GPUs that you as a company can use that technology to be able to build AI models at scale. So they have the data centers to be able to do this. And as you can see, they allow you to rent essentially that hardware for you to be able to train and develop new AI models. So as you can see, this is the pricing of different hardware that they have available on their data centers. You can see these are the options available, which by the way, they're very powerful GPUs that they have available for enterprises and for anybody to be able to access. You can see the price per hour, which is actually quite reasonable given the industry standards. And on top of that, they build an entire AI stack where they have a whole bunch of services that you can utilize to make the development of AI models and AI technologies simpler and more powerful. Now you might be thinking, how is this different than like AWS or Microsoft Azure or even Google's cloud services? And the difference is actually really interesting. So what Nebius is doing is they really just focusing on the AI part versus like AWS and all these different services. They're generalists. They're focusing on all kinds of cloud computing needs. So if you're looking specifically for AI cloud computing services, Nebius may actually be the perfect solution for you. So as you can see, the other thing that differentiates them actually is that they're based in the EU, which is great for EU companies because they don't have to worry too much about the compliance that they need through different agreements and different requirements that they have. And then, like I said, their whole AI stack makes it really easy for you to be able to not only get access to the compute, but every other service that you need in order to train very powerful AI models. Now, on top of this, Nebius, it is backed by Axel, which is one of the best venture capital firms in the world. And most importantly, Nvidia, which I think really adds a lot of value because it means that the company can get access to some of the best hardware that the company has to offer faster than the competitors. Alongside having a great product, the company is part of a phenomenal market, and this is why the CEO chose strategically to focus on this specific segment of the market, because as you can see, this market is actually estimated to have a compounded annual growth rate of 26%. This is absolutely insane, something that is highly unheard of, and if the company executes well, they know they can get a large chunk of the existing market as well as the future growth. Now, my main concern with the company is the financial health, and this is because of the spin-off. The company is actually at an early stage, believe it or not, even though before you can see on the past revenues for Yandex. The company was a real monster. So now they've gone back to making only $117 million of revenue every single year, which is very different than the previous numbers. But also what is concerning is that the company is going to incur some very heavy losses. And this is because the business model requires them to buy a lot of GPUs, and these GPUs are actually very expensive. So it's going to take time before the company is actually going to be able to generate decent profit numbers. And you can see, most importantly, that their margins, as you can see, are quite low, and I don't expect them to be too high. Even though some of their other more digital products that have higher margins, they can increase their revenues, but we will see what happens with this. Now, lastly, the other thing to watch out for is shareholder dilution, because the company is incurring losses. So if they don't have enough money on their cash to be able to cover these losses, they might actually choose to issue more shares to be able to finance these losses. So something to keep in mind. The balance sheet looks relatively healthy. They do have a pretty healthy amount of cash available. That seems pretty reasonable and manageable, but something to keep in mind as well. And then because of the losses, shareholders' equity is decreasing. Now, if you want to know how I got the financials in this format, you can just use whitesheets, where you can just type the name of the company, select it, click on Get Data. I would highly appreciate you checking this out, because this is how we're able to support the channel and provide you with more stock analysis. Now we're gonna bring it all back to the actual valuation of the company and my price prediction for this promising AI company. So what I have here is a model. It's super simple, but it works well for companies that are incurring losses like NBIS. In this case, what I have projected is a revenue growth rate of 40%, which is pretty high, but the company is very young and they actually have higher growth rate at the moment, way higher. Like, I think their growth rate was like 100 and something percent in the last year. Now, I do think that this is gonna decrease, obviously, but 40% for the next 5 years, I think is quite reasonable for a company of this size with their competitive advantages and what they're doing in the marketplace. I have a terminal price to sales ratio of 7.5, which is conservative, but also I think good for a company that has this level of growth. So that's very solid. And then we have the revenue on a TTM basis. Again, this is coming from this whitesheets formula right here that is powering this part of the model. So be sure to check them out. And altogether, what we get is a value of the company of around $4.7 billion. If we get the stock price right here, refresh it to see the current price, we can see the market cap is about 5.6 billion. So our price per share, given these assumptions, would be around $10. Right now, the stock is trading for $24. So therefore, it's a steep buy. It really is. And I wish it wasn't, because this could be a potential great opportunity to get into the stock. And by the way, the 15% discount rate is because, you know, it is a fairly new company. There's a high degree of risk, so therefore it makes sense to have this discount rate and this return. But yeah, what I would do is add this stock to your watch list. Make sure to look at the stock price and the results, and then once the stock price drops, this could be a really good opportunity to get into the company. Because let's say if you wanted to reach this price, you can see it's very difficult. Like, we would have to have a revenue growth rate of like either 55% or 60% for 5 years in a row, which is difficult even for a company of this size. I do think they're gonna do well, but I don't know if they're gonna be able to pull this off. And then on top of that, the price to sales ratio has to be at around the range of 12 for the investment to work out, which is pretty aggressive. I think it's pretty aggressive. So yeah, that's what I would do personally. But again, this is not investment advice. Always make sure to do your own research. If you've enjoyed this video, make sure to subscribe to the channel and let me know in the comments below what you're doing about Nebius stock.